Identification of risks. And before we discuss identification of risks, let's first talk about the high level breakup into financial and non-financial. So you have your credit risk, right? That somebody you gave money to is not paying you back, they're defaulting. So what we are really interested over here is in probability of default, right? Then you have your market risk, also known as systematic risk or systemic risk, which is macroeconomic in nature. So you can measure that with beta, you can measure that with standard deviation, right? Then you have something called liquidity risk, which means you're not able to sell your securities without taking a significant hit on them because the buyers are just not there in terms of the bids, right? And it's easy to get confused between liquidity risk and market risk because what you will see is that they will say, oh, there are not enough buyers in the market, and they'll use the word market, and you might immediately think, oh, this is market risk, but it's not, it's liquidity risk. So if you see that they're talking about somebody having to take a hit on the selling price because there's no buyers available at the market price, so you need to sell a little bit below market to actually sell your securities, that is actually a liquidity problem. It's not a market risk problem. Any macroeconomic issue such as interest rates going up and the stock price is coming down or the bond price is going down if interest rates are going up, that is all market risk. Systemic, system-wide risk, right? That's market risk. Non-financial risk is, to start with, operational risk. So anything related to people, processes, or the computer system, right? So people, process, and system, that is all operational risks. And then we'll have a long list of non-financial risks that we'll talk about, but these four are the main ones, which is credit risk, market risk, liquidity risk. These are all financial. So another question you can get is that which of these following risks is non-financial, and they might give you credit risk, market risk, and operational risk. And obviously operational risk is non-financial. Right. So what did we talk about? We talked about credit risk, where we're interested in probability of default, that the counterparty will not pay us. Anything macroeconomic in nature is market risk, such as interest rates going up or down. And liquidity risk, even though they will use the word market here, please don't get confused. This is not being able to sell an asset at the current market price, right? And you have to lower down the price because the buyers are just not there and the market is not liquid enough. So that is an example of liquidity risk. Now, operational risk, anything related to people, process, or system. Solvency is that it's a very straightforward thing in terms of debt to equity ratio, right? That and this is long term in nature. It's not liquidity, which is short term. Solvency is long term, that if assets go down, you should have enough capital to absorb those losses. Otherwise, of course, the liability starts to take a hit, which means then you have to go bankrupt. So that is your solvency risk. And then now, to talk about your other non-financial risks. See, here things get a little bit tricky. So settlement risk is, let's say there's bank A and they have a deal going on with bank B, and then for some reason bank B is not honoring their deal, right? The settlement is not happening, which would obviously then lead to credit risk because then one of them is defaulting on the payment of the other, but you have to treat them two separately. Yes, there is an interplay between settlement risk and credit risk, but the settlement between two parties not happening for whatever reason is settlement risk. And then of course, if one party gave some money to the other and is not getting it back, that is credit risk. So yes, there is a relationship between those two. Similarly, legal risk can also lead to credit risk. So if you made a mistake in the contract between bank A and bank B, and that's why bank B is trying to run away and not paying bank A, again, that is a legal risk because there's a legal mistake, but then it could lead to a credit risk problem. Similarly, your political risk, right, could lead to a market risk. So let's say my investments are going down or the stock market is going down because something political in nature has happened. So yeah, I mean, to start with, it's a political risk, but then it could lead to a market risk. So again, there's possible interplay between those two. There is also interplay over here. So these two get confusing, model risk and tail risk. So let's say I assume that my financial market returns are going to follow a normal distribution. but let's say they don't, the tails are fatter than I thought they were. So that is an example of model risk. And within model risk, then it would be an example of the tail risk that tails I thought were thin, but they're actually fatter. These three are linked as well with respect to laws changing. Now, if those regulations are changing, then it's a regulatory risk. If accounting rules and regulations are changing specifically for accounting, then that's an accounting risk. Or if tax rules are changing, well, then that's a tax risk. Individuals, of course, face a number of risks as well. So disability, right? Not being able to work anymore, health deteriorating, that's health. Or you could have a much more worse scenario that it's not just disability, the person is not around. In either case, their income goes down. So you have to understand that every person has a certain amount of human capital, and that's the present value of their future earnings, right? So if they're not well or if they're not around, then that human capital is not there, so that asset comes down. So this is the risk of an individual not being able to provide for their family. An exact opposite situation could happen is that they might outlive themselves, in the sense that they thought they would live till 80 and they only had put aside money to pay for their expenses till 80 or maybe 100, right? But if they turn out to live beyond 100, right, so then what if their money runs out? So that's called longevity risk. Of course, there could something be dangerously going wrong with respect to their property, so that there might be some accident, right? So that could be there as well, property and casualty risk. Now, it's very important to understand the interplay between this situation. So let's say there is bank B and there is bank A. And let's take the example of a repo transaction. Now, you should remember what a repo is from your fixed income material, but let me just tell you, a repo is where, let's say, bank B wants to borrow money from me. So I give them, let's say, $99.5 and I take a government bond from them as collateral, right? Now, let's say, and bank B then takes that money and invests it somewhere, let's say in the stock market. So because the market is doing well, everything is fantastic and everybody is in that euphoria, and bank B is a risky bank. Now they've taken that risk. Now let's say the stock market crashes, right? Interest rates go up. Inflation goes up, the Federal Reserve increases the interest rates, the stock market crashes. Now because of that, bank B loses the money. Right? Now they cannot pay me back. So that market risk then becomes a credit risk. And then because they can't pay me back, then that then leads to a settlement risk. So you have to understand that there is interplay between these risks. Now, what is wrong way risk? This is interesting. Wrong way risk. See, now what will happen is that, okay, so the stock market has gone down. Bank B cannot pay me back, so they default on their payment. There's a settlement risk, but don't forget, I still have their collateral, right? But when I go to sell this collateral, which was trading at $100 when I took it from them, but now since the interest rates have gone up, this bond has come down to, let's say, $99 in the market, and I actually gave bank B 99.5. So the risk is actually a double whammy for me, that not only do I lose money, the risk is actually worse than what I thought, right? Because this is called wrong way risk, that not only, see, let me explain it to you this way. When we talk about credit risk, it is the probability of default, right, multiplied by the loss given default. That, okay, whatever is the probability of default, but even if the default happens, I'm not going to lose that much money because I have a collateral in my hand, right? But when the situation starts deteriorating, the probability of default goes up, and because the collateral value is going down, the loss given default also goes up. So my risk actually increases in a non-linear way. This is called wrong way risk. Anyways, you don't need to know too much about that, but hopefully that helped you understand the concept. Right, for individuals, we already talked about human capital risk, right? That might be because of, let's say, God forbid, mortality, right? Or disability, right? So, but either way, they are not able to earn what they thought they would be able to keep making. And this market risk is related to their investments, that they are also investing in the stock market or overall capital market, and the investments could go down, right? A very important link between these two is that, let's say this person doesn't having a disability, he's not having a mortality, he's just losing his job, right? Because whatever, something went wrong with their business, right? And if they had put all their money as well in the stock of that company, then that is something we should understand as well, that there is interplay between market risk and human capital risk as well. If an individual puts all their money in the same company's stock which they're working for, so they could actually lose both together, right? So that's something we have to be careful of. Okay, let's do some questions. Which of the following is not a financial risk? So what do you guys think? Credit risk is a financial risk? Yes. Market risk is a financial risk? Also yes. Liquidity risk is also a financial risk, but operational risk is not a financial risk. Which of the following best describes an example of interaction among risks? So what we want to see over here, some interaction between market risk and credit risk, right? That market is crashing and credit risk is going up. Or what I want to see is maybe some interaction between credit risk and settlement risk, right? We looked at those interplays as well. So let's see what the options are telling us. A stock in Russia declines at the same time as stock in Japan declines. Those are both market risks, right? So no interaction there. Political event causes a decline in economic conditions and increase in credit spreads. Political events cause a decline in economic conditions and increase in credit spread. Let's hold on to that. Let's read the third one and then come back. A market decline makes a derivative counterparty less creditworthy while causing it to owe more money on that derivative contract. Yeah, C is definitely an obvious link between market risk and credit risk. So market is going down and that's why credit risk is going up. Now, why I said hold on to B is because obviously my political risk is causing my credit risk to increase. So there is definitely an interaction over there as well. But the more obvious answer, because they've asked for best, is C. So you have to be a little bit careful here, right? You want to go for the big risks. Whenever you see this interplay question, try to identify the relationship or interplay between these big risks, which is market, credit, settlement. And yeah, those are the main ones. All right, which of the following best describes financial risk? So increase in interest rates is definitely a market risk, right? Macroeconomic in nature, and market risk is an example of financial risk. So that seems to be the correct answer. Risks that regulations will make a transaction illegal, that's regulatory risk. Risks that an individual trading without limits or controls, so that would be an operational risk, right? Which of the following is not an example of model risk? Okay, this is going to be tricky. Assuming the tails of the return are thin when they are in fact thick or fat. So we thought it was going to be a normal distribution, but it is not. So that is obviously a model risk. And we're looking for not a model risk. So this will not be an answer. Using standard deviation to measure the risk when returns are asymmetric. So again, I mean, we thought 68% data would be within one standard deviation plus minus, right? Assuming that it's a normal distribution, but it's not, because the returns are not symmetric. It's not equally distributed on both sides, right? It might be left positively skewed or negatively skewed. So that again is a model risk. Using the 1 year risk-free rate to discount the face value of a 1 year government bond, there's no risk there. That's a perfectly fine, normal thing to do. Right. Which of the following is the risk that arises when it becomes difficult to sell a security in a highly stressed market? Now, this might confuse you because they're using the word market, but please keep in mind that it is becoming difficult to sell a security, which means this is a liquidity risk. A systemic risk is a market risk, that the market is going down because of some macroeconomic problem, right? Wrong way risk is something we've talked about already, that like two things go down at the same time. So your probability of default is going up and your collateral value is going down. But that has nothing to do with this liquidity issue of a stressed market. Right. The risks that individuals face based on mortality, so which basically means human capital is going down. So either because of disability or mortality, you're not going to be able to provide for your family, right? So that is the risk of loss of income to their families. Covariance of risk associated with human capital and their investment in portfolios. Yeah, so this is what I was talking about, right? Your market risk comes into play over here, that okay, you're losing your job and your investment portfolio is going down. So that is a market risk problem, and we need to be aware of that, but that has nothing to do with the person, getting disabled or passing away, God forbid. And C says the interacting effects of solvency risk and the risk of being taken advantage of by an unscrupulous financial advisor. Again, operational risk. All right, so let's take a break here. We'll come back and jump into measuring and modifying risks.